Coach John Davis here. Hope this comes through okay. Uh, I've had a lot of questions recently about financial statements. So I thought today I'm just going to make this quick loom, share with you guys some of the basics in relatively simple terms. I'm sure a accountant could fix all of them. But there's three financial statements that I think are most critical. One is you'll hear it called the P&L, or the profit and loss statement, or the income statement. And obviously, that's going to tell you, are you profitable? It measures your performance over a period of time. Um, you can use a number of them to really understand your business. A lot of times people talk about the total business in their P&L, but you can also create a P&L for types of customers. So if you do one type of product or service, or let's say three types of products and services, you can do the P&L for product A, product B, and product C, and you can understand your profitability across the business. It takes some understanding what drives your costs, so it can get a little bit complicated, but it can also be incredibly powerful to figure out what part of your business you want to grow. Your P&L can change. You can look at it through time periods, so you can look at it for year one and year two, and figure out, well, did I gain ground or did I lose ground? And also, it helps you understand the importance of your cost of goods sold or your expenses in the business. Another key item is the balance sheet. What I like about the balance sheet is it's kind of like your net worth or your equity. One way to think about it is if you're playing a game of Monopoly or life, at the end of the game, you sell your houses, you sell your properties, you cash in everything, and you have dollars left over. And that's kind of what it is. It's the scorecard of what do you have at any point in time, or where your balance is. Are you positive or are you negative? What are you worth? And I'll show you what this looks like. And then the last one's the cash flow. And the cash flow statement just kind of looks at how your cash has moved from the beginning of the period to the end of the period. It could be a week, a month, a year, and it helps you understand what's really driving everything. So what I'm going to do, if this works here properly, I'm just going to walk through a couple examples. I've created some example documents. See if I can move my face out of the way. There we go. So here's an income statement. So let's just say in my business, my net sales for this time period were $2,500,000. Oops, or if I type it right. And then let's say my cost of goods sold. So this is the cost of my materials, the direct labor to build a product, some basic expenses, whatever it is I'm assembling. Let's just say it was $750,000. My gross profit is my net sales minus my cost of goods sold, so it's $1,750,000. But clearly, I'm going to have to pay people. I have to pay rent. I did commissions. I have insurance, other types of business expenses. And let's say that totaled $1 million. So then what that tells me is my net income from operations is my profit minus those other expenses. So I made $750,000. Now let's say part of my business, I get some commission because I sell it, or I got interest on the people that owe me money, or I have some material, I own the building, but I'm renting out part of the building, and I picked up $50,000 in other income. And then I had other expenses, whatever they may be. I was paying for accountants, I was paying for lawyers, whatever it may be. And so my other expenses were $400,000. My earnings before income tax is the $750,000 from operations plus the $50,000 in income minus my other expenses. So I had $400,000. And then let's just say that I had to pay an income tax of $100,000. My net profit here is $300,000. You can call it net profit, net income. I made $300,000, which is 12%. So $300,000 divided by my net sales of $2,500,000 gives me 12% as my net profit. So it's interesting when you hear people talk, oh, my profit, there's gross profit, net profit. What really matters is the net profit. And then once we've done this, we can understand, well, if I want to reduce my expenses, I want to make more profit. Obviously, I can drive my revenue up, but I might want to look in these big buckets. My operating expenses of $1 million. What was that all about? What did I do there? The next largest areas would be, the cost of goods sold, how much control do you have that over that or your other expenses? So that's where the value of the income statement comes in, is it starts to tell you where you can do your cost reduction or the value of the growth if you grow your business. So next one I want to talk about is a balance sheet. This one seems to confuse everyone. Again, this is the one where I say it's kind of like your scorecard or your net worth. So let's say I'm a business and sitting in my bank account, I have $500,000. And I have people that owe me $25,000. And the materials that I've built that are sitting on the shelf that I haven't sold yet, let's say I have $75,000. My total current assets, and it current means I can turn it into cash quickly, is $600,000. The cash obviously is cash. If I can get I say quickly, let's say in the next 30 to 90 days, whatever it may be. So I have $600,000 in current assets. My long-term assets, my plant and equipment, let's say I have that $1 million building, which I've purchased. And let's say between the building and the equipment, let's say it's depreciated $100,000. So an example of that would be just like, I can't type. You drive that truck off the lot, it drops in value right away. Well, if you have a couple trucks, it's gonna depreciate 100,000. So, but that's a long-term asset. It takes a little more time to turn those assets into cash. So your total long-term assets are 900,000. My total assets is 1.5, right? 600,000, 900,000. Those are the assets. That's what I have in property. So I go back to the Monopoly example. That's your properties and your hotels and your houses. Those are your assets. So the next side is you look at your liabilities. So liabilities have short-term and long-term, just like your assets. So a short-term debt might be your credit card debt. Maybe you have $50,000 in credit card, business credit card debt. Your accounts payable. This is what you owe to your suppliers. Let's just say that you owe $100,000 for payables. That means your total current liabilities, the debt that you have to pay here in the near future, is $150,000. Now, long-term debt, I've got $1 million building and equipment. Let's say I've paid off $250,000 of that loan, so I still have a loan due of $750,000. Now, liabilities and equity have to equal assets, which is always, to me, kind of a backwards way of saying it. The way I like to look at it is your equity right here, or your net worth, is your assets minus your debt. That's a different way to do it. So in this case, there's a gap of 600,000. So my equity is 600,000. So my net worth, in my vernacular, is 600,000. Sure, I have assets worth 1.5 million, but if I were to sell all those assets, I still have to pay my debts of 900,000. If that makes sense. So it means I would leave the game with 600,000 in my pocket. So this is how your assets equals your liabilities plus equity. Again, I would say it. Your equity is your assets minus your liabilities. Hope I didn't confuse you on that one. Okay, last one, cash flow. Cash flow is just that. It's the net of the cash flow that's come into your business. And it happens in a couple different areas. So let's just say you've got $200,000 in the bank. And there's three elements of cash flow. From operating activities, that's what your business generates. From investing, because your business could be invested. And then what's happened on the financing side. So in this case, I have $200,000 in cash and receipts from sale of goods and services. Remember, I sold $2.5 million. And my payments to employees, my taxes, my suppliers was $1,850,000. That meant that my net cash from my operating activities is $650,000. 2.5 minus all my expenses. Cash flow in, net cash flow for my business is $650,000. I probably could have made these examples match a little bit better. Now, what about cash from investments, sale of investments, vehicles, and properties? Maybe you sold off a small building or you sold a vehicle and you got $50,000, but you purchased $250,000 worth of equipment. So your net cash of investing is 50 minus 250 is 200,000. Now finally, let's look at the cash flow from financing. So let's say you proceeds from issuing shares, borrowings from banks or whatever. That's if family member puts in money or whatever. I'm gonna ignore that for most small businesses. But maybe you paid back $100,000 of that mortgage, right? Payments to dividends and shareholders. Maybe you paid back your uncle who put money into your business from the get-go. So your net cash flow from financing was 250. So our net cash flow during the period, we brought in 650 from our business. We invested $200,000 to grow our business. We sold off some equipment and we bought some more equipment. So net there's 200. And then we paid back other debt from prior financing of 250. So we had 650 minus our 200 minus our 200. 250 gives us our net cash flow during that period is 200,000. Meaning from the beginning of the year or the month or the quarter, whatever, I went from 200, I added 200, and now I have 400. So I hope this helps explain some basic financial statements. If you have any questions, certainly reach out to me, give me a call. I love explaining these and then understanding yours and figuring out how you can leverage these three tools to grow your business. I'm Coach John Davis, and I'll talk to you later.